Let's just begin with a presentation, shall we, from Mr. Charles Goodhart, former MPC, monetary policymaker over at the Bank of England. On central bank independence, he said the following today in his presentation: a greater likelihood of conflict between central bank and Treasury. Politicians and Treasury will win. And on central bank independence, he said it was nice while it lasted. What's in store in terms of the future?
Well, I don't necessarily agree with Charles on that. What I think we may see if the whole global economy turns down again is that we'll have to consider even more radical policies than we did before. And both I and Ben Bernanke have pointed out that in some circumstances you should even consider fiscal deficits which are permanently financed with central bank money. But as Ben pointed out in his Brookings Institute blog a year ago, you can make that completely compatible with central bank independence. As long as it's the central bank which determines the maximum amount of such a monetary finance, you've still got independence. I think independence is still worth defending. However, let's see the big reason why people might challenge it. The central banks, independent, have been very effective at achieving low and relatively stable inflation. I think we've also got a more resilient financial system. But if you step back and say the last 20 years, what has economic performance been like? It was good for the first 10, and it's been a disaster for the second 10. And I think there's going to be social pressures coming back, which you see political pressures of people saying this system isn't working for enough people to be sustainable.
Lord Turner, you did mention financial stability, and just in terms of that, I wonder, when we think about central bank independence, it has come with inflation targeting. Has inflation targeting made finance and financial systems more stable?
Well, not in itself, and I think the great fallacy of the years before 2008 was the belief that it was enough to have one objective, low and stable inflation, pursued with one a policy instrument, which was the interest rate. And we achieved low and stable inflation. It was called the Great Moderation, and then we still had an enormous financial crisis. And what that illustrates is that low and stable inflation is a good objective, but it's not enough. What we did before 2008, we ignored the huge build-up in debt which was occurring, private debt, across the world. And the fundamental problem we have in the global economy is that's still not resolved. All that's really happened since 2008 is the debt has moved around from private to public sectors or from the advanced economies through to China. But it's still there. And that's why we're trapped in a situation where we can only really keep this economy going with very low interest rates, but very low interest rates that then create their own problems. So yes, inflation, low and stable inflation is a good objective, but it's absolutely not enough definition of the objectives of macroeconomic stability.